We are jumping straight into an analysis report on Paranovus Entertainment, ticker PAVS. It's a volatility setup after a 1-for-100 reverse split.
And the core idea is a contrarian, oversold bounce trade.
Right, and it makes this really strong case that volatility is coming, the calm before the storm, by focusing on how tight the float has become.
Okay, so let's start there. To really maximize the logical punch, I think the analysis needs to structurally integrate the cause and the effect here.
The cause being the reduced float, and the effect being the trading plan.
Exactly. The cause is that dramatically reduced float and liquidity. The effect is how incredibly vulnerable those resistance levels become.
I see what you're saying. The report right now, it sort of separates them, doesn't it?
It does.
You get the context reverse split, tight float, and then you get the technicals. You know, the 245 gap fill and the 280 breakout. So what's the problem with that separation? The market knows what a tight float means.
Well, it knows in principle, but the analysis just jumps from the float shrinks to here are the price levels. It leaves the mechanics of that breakout feeling a bit assumed rather than explained.
Okay.
If you're going to call this the storm, you really have to show the physics behind the lightning strike. It says volatility will explode, but it doesn't explicitly connect that tightness to why, say, 280 is suddenly so fragile.
Right, I get it. So the thesis depends on a huge move happening on low volume, and that mechanism needs to be front and center. But, my question is, isn't the point of a report like this to be concise?
It is.
Won't adding a deep explanation just slow down the pace? You might lose the trader who just wants the price targets.
That's a fair challenge, but I think in this case, the structural link is just too important. It elevates the whole thing from a simple chart read into a real market mechanics analysis. The report should use those mechanical changes to justify why these resistance points are so critical now. Why a move to $3.50 is actually plausible. Right now, the technicals and the float discussion are sort of running on parallel tracks. They need to be woven together.
So we make the float reduction the reason the technical levels matter so much, not just background noise.
Precisely.
So how do you do that without turning it into some kind of academic paper?
It's all about restructuring that section, the storm levels. Instead of just listing them, you explain the direct impact of the float reduction.
Okay. That's really concrete.
Yeah. For example, you could add a sentence explaining that because the float is so tight now, reclaiming $2.30 or breaking $2.80 will require a disproportionately small amount of buying volume. You could even get hypothetical and say, previously, breaking $2.80 might have needed 5 million shares of volume. Now we project 2 million could send it straight to $3.50.
That's a powerful way to do it. You're merging the big picture with the specific trade levels. It gives the analysis a real edge.
It does. You've just massively solidified the upside thesis.
Okay, building on that, if we've tightened a mechanical structure, then that structure needs to be confirmed by some kind of underlying value. Let's talk about the fundamentals here.
Right.
The analysis brings them in at the top to fight that fear people have around reverse splits. It mentions the pivot to AI entertainment and massive revenue growth.
Which is fascinating, and you absolutely need that for the contrarian angle. But here's the question. Is the connection between that AI pivot and the key trading levels fully established? The report should leverage those fundamental catalysts to anchor that critical $2 support level. It would make the floor feel less technical and more, fundamentally justified.
Okay, but the $2 to $2.03 level is currently defined as a double bottom. That's a pure chart psychology point.
It is.
Given the audience here is probably technical traders, why do we need to force the fundamentals into a support level? Isn't that just complicating a clean chart read?
It makes sense to think that, but remember the context. This is a reverse split.
Right.
And the number one fear after a reverse split is that the stock is just going to bleed out forever, no matter what the chart says. So if that $2 technical floor breaks, people assume the worst. The analysis doesn't quite show how the revenue growth and the AI pivot make that $2 level the real loading zone, If the market moves on expectations, shouldn't those expectations be used to confirm the floor?
So you're saying by integrating the fundamentals, you change what that technical support even means?
Exactly.
It's not just a pattern on a chart anymore. It becomes the price where the market has factored in all the bad news.
That's it. Precisely. The suggestion here is to argue that the $2 level represents a new post-split valuation floor. It's where the market has priced in the distress, but it has not yet priced in the future growth from the AI pivot.
That's a critical distinction. It turns this from a simple oversold bounce into a confluence of technical and fundamental support.
A value play disguised as a volatility play.
Which gives you way more conviction for those higher targets.
It really does. And for a concrete example, the report could just briefly add a comparative point. Say something like, based on the new revenue trajectory, $2 might represent a low-end industry multiple for similar AI entertainment stocks.
I like that. It grounds the technical level in reality.
Or you could frame it differently. Frame that low of $2.03 not just as a chart pattern, but as the moment the market started pricing in the AI story. That makes the $2 level crucial for the narrative's validity, not just for chart psychology.
That's a powerful shift. Okay, so once we've established the mechanics and anchored the floor, we have to look at the other side of this, the risk.
Yes.
Especially for a high-risk, high-reward, contrarian thesis like this one. The strategy now, it emphasizes patience, right? Waiting for the first 15 minutes, and it defines two scenarios. Bullish is holding $2.03, and bearish is slicing through $2 down to 180.
And that's a standard, effective way to frame risk. But to maintain credibility in an analysis with the storm in its title, I think the report needs a more proportional and, frankly, a more detailed discussion of the downside.
Okay, I see the point about detail, but we're talking about sophisticated traders, right? They know how to manage a basic stop loss. Does the report really need to hold their hand if it cracks to 180?
In this case, yes, I think it does. Because the analysis focuses so heavily on the massive upside to 350, there's a real risk that it encourages people to chase an entry or to hope trade through a small break of the floor. The danger zone is mentioned so quickly. That 20-cent downside seems tiny compared to the 130-plus potential upside. For a play this volatile, the risk plan has to be just as dramatic and detailed as the reward thesis.
So the core opportunity is to calibrate the risk profile, to get really specific about what happens if that core support fails.
Absolutely. The way to strengthen the bearish scenario is by providing explicit stop-loss or re-entry metrics. It balances out the whole contrarian theme by showing robust risk management. It shows this is about discipline, not just gambling.
So we need to turn that general warning into a truly actionable sequence. How do you make that failure point more quantifiable?
Let's give some concrete examples. First, you have to expand on what cracking $2 with volume actually means.
Okay.
Suggest a specific threshold. For instance, state that if PAVS stays below $2 for 5 consecutive minutes on above average volume, the trade is invalidated, period.
That gives the reader a clear, quantifiable condition. No arguing with the chart.
Exactly. And second, offer a real plan for that $1.80 area beyond just wait for the flush to finish. You could suggest a potential secondary entry point if 180 holds, but only if the selling volume completely dries up.
So you're differentiating a true breakdown from a quick shakeout.
Right? And to cement the discipline, you state the definitive stop. If it touches 175, the trade is off for the next few weeks. That really hammers home the discipline required here.